Hello everyone. Today we will talk about the cash flow forecast. First, we need to know the importance of cash and cash flow forecasting. Why do businesses need cash? Businesses need cash because they have lots of expenses they need to pay. Example, they need to pay the employees' wages, the suppliers for goods and services, rent, heating, lighting, and other costs of its premises. Without cash, a business will fail. How does a business make sure it has enough cash to pay its bills? Of course, it can do so through the cash flow management strategies. They have to make sure that there is enough cash coming into the business to cover the cash that goes out of the business. Example, they have to ask themselves, is there enough cash from the sale of goods to cover the amount needed to pay the suppliers? Businesses also need to think about how can cash flow into a business. Number one, cash flows in to the business through the sale of products, payments made by debtors. Debtors here are customers. Borrowing money from external sources, the sale of assets, and investors. Here I need you to pause the video for a minute to think about these transactions. Are they considered cash inflow or cash outflow? Pause the video and think, then check. First, purchase of new computer for cash. Of course, this is buying, so you are paying money, so this is cash outflow. The sale of goods to customers, and there is no credit, you get all your money on cash, not credit, so this is cash inflow. Interest paid, this is outflow. Wages paid, outflow. Debtors pay their bills, which is the customers, so this is inflow. Additional shares are sold, you are selling shares, so you receive money in return, which is cash inflow. Creditors or the suppliers are paid, you pay for them, this is outflow. And the bank overdraft is paid off, this is cash outflow. So, purchasing goods or materials for cash, this is considered the cash outflow. If you pay wages, salaries, and other expenses in cash, this is outflow. Purchasing fixed assets, outflow. Repaying loans, paying creditors. Creditors here are the suppliers, also is considered cash outflow. So, we need to be familiar with the cash flow cycle, how it happens. First, cash is needed to pay for what? The materials, wages, rent, and so on. And from the material, we will produce goods. So what do we do after producing goods? We sell them. After selling them, we get cash payments. And then we use the cash to buy the material and pay the wages. And from the material, we produce goods and so on. This is the cash flow cycle. Here we will have a look at some businesses that failed because their owners didn't manage the business's cash flow well. You can pause the video and go through these cases. But the common mistake these companies made is that they didn't manage their cash flow well. This is the key point. We need to know also that cash is not the same as profit. A profitable company can run out of cash. And if it does and can't pay the debts, then even though if it's profitable, it might still not be able to survive. So in the short run, cash is more important than profit. What is profit? It's the surplus after the total costs have been subtracted from the sales revenue. Let's have a look here at this example that shows the difference between both the cash and the profit. What's the gross profit in June? So we need to know first the formula of gross profit. Gross profit formula equals revenue minus cost of sales. Revenue is the money we receive from selling goods, from the sales. Revenue is the sales. Okay, and the cost of sales. So gross profit, revenue minus cost of sales, which is 40 minus 15. This is $25,000. Now let's assume that the business started the month with no cash. How much cash did it have at the end of June? And the key word here is the word cash. So the net cash flow is the cash inflow minus cash outflow. So let's see, how much cash did the company receive? The actual cash actually didn't receive the 40, it received 50%, which is $20,000, and the cost of sales, these are the expenses, 15, so it's going to be 20 cash sales minus the 15,000, this is $5,000. So it's clear that there is a difference between the profit and the cash flow. Here we've got 25 and here we've got only 5. So why is the cash figure is lower than the gross profit? Because although the goods have been sold, but the cash payments were received for how many? For only half of them. This is the actual, the liquid cash that the company received. So, yes, can profitable businesses run out of cash? Yes, and this is a major reason why businesses fail, and it's called insolvency, like it is illiquid. So, how is this possible? The mistakes that businesses make are allowing customers too long a credit period, just to encourage sales, so they allow customers to pay on too long a credit period. Also, businesses may make a mistake like purchasing too many fixed assets at once, expanding too quickly and keeping a high inventory level. This means that the cash is used to pay for higher inventory levels, and this is often called over trading. Another example, you can pause the video and answer the questions, then check your answers. Pause the video now. Here are the answers for you to check. And this is the summary of the cash flow. So, cash flow forecast. To be familiar and to make it easier for you, you need to investigate new businesses that have set up in your area, and you have to ask yourself, why did they need cash in the first few months of trading? So, try to think and brainstorm this. So, the key word here is the survival of any business depends on the cash inflows being greater than the cash outflow. So, if we need or if we want to end up having a positive cash flow, this means that the cash inflow should be greater than the cash outflow to have a positive cash flow. But in case the cash inflow is less than the cash outflow, this means we will end up having a negative cash flow. which one is better? Of course, having a positive cash flow. Okay. So, what if there is a possibility for having a negative cash flow? Businesses, first of all, need to be accurate, and they need an accurate forecast for the size and timing of cash inflows and outflows in the future. It's called the cash flow forecast, and it enables businesses to identify any future time periods with the cash shortage. This is very important. This is the importance of creating the cash flow forecast. What is a cash flow forecast? It's an estimate of the future cash inflows and outflows of a business. This makes businesses ready for any cash shortage that might happen in the future, not to wait until the shortage happens. No, they have to be ready for it. Let's have a look at this simple cash flow forecast. We've got the cash coming in, which is the receipts. This is 10, only one item. Total inflow is 10 in January. Cash outflows for the payments. And the net cash flow is the difference between the total inflow and the total outflow. There is in numbers 10 minus 7 equals 3. 15 minus 27, this is negative 12. 18 minus 12, this is 6. And then the opening balance, this is how the business starts the month. So at the beginning of January, before having money in and cash in and cash out, they had 5. So, and they got the net cash flow 3. So 3 plus 5, that's 8. Here, negative 12 plus 8, this is negative 4. 6 minus 4, this is 2. The most important items in this forecast are 5 items. The total inflow, the total outflow, the net cash flow, opening balance, and the closing balance. And you have to know the relationship between them and what are the formulas. So the previous one was a simple one. Now, what if you get an annual forecast like this? Don't panic at all. Again and again, the 5 main items you should care about are the cash inflows. Here the total only, they got it from the cash sales. We have only one item for the cash inflows, the cash sales. This is the money in. They got the money in from the sales. Then for the cash outflow, we have wages, plants and trees, purchases, and so till here. This is the cash total cash outflow. We got 41,100. This is the sum of here the wages, the 20 plus 20 plus 0 plus 1,000, 0 and 100. This is the total cash outflow. And then the difference between them is the net cash flow. Example, we've got 70 minus 41 100. This is 28,900 and so in the rest. So the net cash flow is the difference between cash inflows, total inflows, and total outflows. Then the opening balance and the closing balance. The closing balance shows how much cash the business expects to have at the end of each month. If the closing balance is negative, then this means that there is a cash shortage. These are the definitions. Opening balance, the amount of cash held by the business at the start of the month opening. And this is net cash flow, the difference between inflows and outflows. And the closing balance is the amount of cash held by the business at the end of each month. And it becomes the next month's opening cash balance. We will see this in the figure. So we've got questions here. In which month is there going to be a negative closing balance? Where is the closing? It's here, negative, in, of course, February. And what has caused the balance at the end of this month to become negative? It's the difference, of course, between the total inflow and the total outflow. So the payments are greater than the receipts, which is the total outflow is greater than the total inflow. So, as we said, the cash flow forecast helps businesses know in advance that there is a cash shortage, so they have to be ready and to prevent this from happening, not to wait until it happens. Okay. So, how to construct it? We've got, as we said, the total inflow, total outflow, net cash flow, and remember, between the total inflows and outflows, we deduct like total inflows minus total outflows. This is the net cash flow, and then we add up together the net cash flow to the opening balance to get that closing. So here we've got minus and here we've got plus. The signs are very important. One more, when we constructed the cash flow forecast, remember that the closing balance of the previous month becomes the opening balance of the coming month. Here we end up January with 8, so this means we will start February with 8. If we end February with -4, this means we'll start March with -4. This is the opening of the next month. Now let's assume that the payments for February include the purchase of a new delivery van that cost $16,000. So one decision can make all the change. If the decision to buy this vehicle is delayed only 1 month, instead of paying the 16 here in February, which makes the payments larger than the receipts, we will postpone it. We will not pay the 16 here. We will deduct the 16 here and we will add it here. We will add the 16 in March in the payments. So instead of having 12, we will add up the 16 of the vehicle or the van. So it will be 28 and we will deduct it from here. So how will the cash flow forecast look like after these amends? Let's see. We will deduct the 16 from the 27, it will be 11 only, and this month will end up, of course, the net cash flow will change, so will the closing. So instead of having -4, which is the cash shortage in February, we are having 12 here in February, which is positive. And also this new closing balance will change and will be added here in March, and also the payments will be here changed. Instead of having 12, it will be 28, and the month will end with positive 2. As you see, there are no negative closing balances. So delaying the purchase of the delivery vehicle improves the cash flow by removing the negative cash balance in February. If the business can't delay the purchase, if it's urgent for the business to do so and they cannot do this step, the previous step, which is delaying the purchase of the machine, so what can they do? They have to look for another source of finance, especially when it comes to cars, and so they can look for hire purchase, leasing, or a bank loan. As the cash shortage is forecast to be very short term, then the business might arrange the keyword for any shortage. The short-term cash shortage is the overdraft. These keywords always come together. both of these options are more likely, are more costly than delaying the purchase, just in case if the business can't delay. But the best option, of course, is delay, because here there is a cost. Now I want you to pause the video and think about the answer. Complete this cash flow forecast. Now let's see what's the net cash flow. Net cash flow is the total inflow minus total outflow. So this is 26 minus 20, this is 6. And the opening balance is the closing balance of the previous month, which is negative 4. And the closing balance is net cash flow plus opening balance, which is 2. The same here, net cash flow is total outflow minus total inflow minus total outflow, that is 5. And then the opening balance is the closing balance of the previous month, which is 2. And the last thing, closing balance, is net cash flow plus opening balance, that is 7. We need to comment on the cash flow forecast between January and June, and how could the finance manager use the cash flow forecast to better manage the cash flow. These are the suggested answers. So, how to interpret the cash flow statements? Again and again, the most important part is the closing balance. How do businesses end up at the end of the month? So, if the business's cash position is forecast to become negative for the short period of time, management might decide to finance this with an overdraft. It's a key word for the cash flow forecast. However, of course, overdrafts can be very expensive. Before deciding to use an overdraft, manager should consider ways of removing or reducing the cash shortage, as we did. Even if they only reduce the size of the forecast cash shortage, this will at least reduce the size and the cost of any required overdraft. It's like try to manage what you can manage in the cash flow forecast, and then the rest will be taken as an overdraft. How to finance a short-term cash shortage? Of course, ask trade receivables, the ones that you have against the customers, to pay for goods more quickly by offering them. How can you encourage them to do so? By offering them discounts. Negotiate longer terms with suppliers. Delay the purchase, as we did in the previous example. Delay the purchase of non-current assets until the cash flow improves. Find other sources of finance for the purchase of non-current assets, like, as we said, hire purchase, leasing, and so. It's very important to know how to overcome the cash flow shortage, because this is a common question. Here, I want you to read this example. You have to amend this cash flow forecast according to the information here. It says that this company offers an early payment discount to the customers, so they expect that this will improve the inflow by 1,000 inflow in first 2 months, and 2,000 in 3 months 3 and 4. So you will make amends here and here. And in month 3, we're planning to replace one of their delivery vehicles with the newer model. They have decided to look at other ways of financing this purchase. They are considering leasing the vehicle instead of an outright cash purchase. This will reduce, this is the key word, this is the change that you're going to make, reduce the cash outflow in months. 3 ways cash outflow here. It will reduce the cash outflow by 8 and will increase the outflow by 2. So, pause the video, make all these amendments, and tell me how the final forecast will look like. You can pause the video now and then check your answers in the coming slide. Here, as you see the difference, all the months will end up having positive cash flow, and this is what we need. And instead of having month 3 with -4, all of them will end up having positive closing balance with only one decision, like encouraging the customers to pay earlier, and also to have to lease the machine that they want. And this is the comment. How can cash flow problems be overcome? This is the summary. It depends on your decision. Maybe you want to increase the bank loans, how it works, and the limitations. Of course, the limitations of any loan is that you have to pay the amount borrowed in addition to the interest. If you delay, it's good, but the suppliers, if you delay payments to the suppliers could refuse to supply any further material, and they could offer lower discounts if you pay late. Asking debtors here are customers to pay more quickly, but the customers may look for competitors who won't ask them to pay earlier like you. If you delay or cancel the purchase of the capital equipment, the long-term efficiency of the business could decrease if it's urgent to buy this machine or equipment and you delay it. A quiz, test yourself, pause the video, and check. If you answer these questions correctly, then you can move on to the next lessons. If not, so feel free to review this lesson again. And this is your assignment. Read the case and answer these questions. That's all. Thank you so much.